There's been a lot of talk about the property market recently, and we figured that we should talk about tax and investments in property. So there are two main taxes that we should be talking about, and most of the time, two main transactions that happen in property. One, when you buy a property, most likely you'll be renting it out if it's an investment property. As a result, we should be looking at rental income and rental expenses. So normally what would happen is that you'll rent the property out and you'll have some expenses such as interest on your loan, repairs and maintenance, council rates, water rates, depreciation on your equipment in the house, or depreciation on the fixtures and fittings in the property. And at the end of financial year, what you'll work out is you either made a profit on the rental property or you made a loss on the rental property. If you own the property in your personal name, what would happen is that you would also make income if you're working for a employer, or you would have started a business as well. What would happen with the rental income and expenses is that that income would offset or add on to your individual tax return as well. So assume that your rental income was lower than all your expenses throughout the year. That means that you made a loss. And as a result of that, you would add your losses into your tax return, and it would actually offset your other income that you've made throughout the year. And that's pretty much what they call negative gearing. If you made that loss and you offset your income, then you most than likely get a tax refund as a result. And that's how tax works for the first transaction. Not many people know about the second transaction, and the reason why is because when you buy property, the general picture is that a lot of people don't like to sell because then they have to deal with tax. But let's just jump into it. So how it works is that normally you buy a property and you would spend whatever it costs to buy a property, and as a result, you would have that as your cost base. And when you do decide to sell your property, you would also make a profit or make a loss. And that transaction there gets taxed by capital gains tax in Australia. And it's taxed differently in your individual tax return if you own the property in your personal name. If you've made a profit or made a loss, that profit or loss gets isolated and doesn't actually offset your other income that you've earned throughout the year. Capital gains income and expenses gets treated differently. If you made a loss, it's carried forward to offset future capital gains. The good thing about capital gains is that you can pretty much get a 50% discount if you've owned the property for more than 12 months. So basically, if you've made a profit, and let's just assume that you've made 100K, so you bought the property at $1 million and you sold it for 1.1, you're gonna have to pay tax on that 100K. And because you've also made money in your personal name as well, your tax rate could be at the highest tax rate at 45%. And because you have a capital gain and you've owned the property for more than 12 months, you don't actually pay 45% of that 100K. You can get a discount of only paying 50% of that 45%. So essentially, what you'll get is 22.5% in tax. Quick side note though, if you're a property developer, basically all those income tax and the capital gains that I was talking about in this video doesn't apply to you. It's best that you go and speak to an accountant and or tax expert in regards to property development and investing in property. So if it's your first time investing in property, the information you'll need to keep is your contract of purchase, your legal fees and expenses in relation to purchasing the property. And then when it comes to your rental income and expenses, if you're renting it out through an agent, you'll get an annual rental statement. So collect that, and you would have also paid some expenses that your agent wouldn't have paid for you. Such expenses would be your interest on your loans, sometimes council rates, and sometimes some repairs and maintenance that you paid out of pocket. You need to get that information down either in a spreadsheet or have those copies of those invoices and send those over to your accountant when you need to do your tax return. That's basically the knowledge that you need when it comes to investing in property and how tax works. But every situation is very different, and some situations are very complex. So it's best that you speak to your accountant or tax expert in regards to investing in property.